Well, generally speaking, we saw earlier this year some bursts of volatility that happened in the US in February and also in other markets. And then we saw a very quick rebound. We also saw some emerging market stress environment earlier before the summer, and then also afterwards a very quick recovery. Generally speaking, there is some tensions in the markets in this year. There is some volatility happening, but I guess investors are staying cautious. They are looking for different solutions in the market. They are expanding their allocations to more defensive allocations if possible. And I guess this we'll see towards the end of the year, so more cautious asset allocations, I guess. In the ETF industry specifically, what we observe is we still see a positive momentum in terms of assets under management. So investors are still investing into the passive, but we observe effectively more allocations, across broad solutions. So more towards the fixed income, higher quality assets, which help to diversify portfolios of investors. Well, generally you have to understand that in passive space, we as a provider, we are trying to equip our investors with a broad set of tools. And in the end, it is investor who decide on a specific allocation. If there are investors who are concerned about the valuation of technology sector, they can easily divest from technology sector with the use of, for example, smart beta ETFs or some other solutions, or maybe divest from US as such. It is true that in the market cap indices, the exposure to technology sector is enormous. Now it's about 25%, but there is a way to divest from technology should investors be concerned about that. Yes, well, the Eurozone equities are less invested into the technology, right? The traditional sectors like financials and healthcare, they have considerably more weight. But of course, in Eurozone, financial sectors, there's also some stress going on. And the same holds true for healthcare. But nevertheless, there is always a way to diversify the portfolios, right? From certain sector-specific biases with the use of different tools that are available to investors. As an ETF provider, right, our job is specifically to deliver solutions to investors so that investors can allocate to different either market segments or different asset classes. And we basically are trying to be extremely responsive to client needs. Over the last few years, there was an extreme boom in equity market, and we have been delivering a lot of equity solutions like smart beta or socially responsible investments. But we see a growing interest, for example, in the fixed income space, because that segment has been underdeveloped with regards to the equity. So we've put a lot of emphasis on development of fixed income capabilities in fixed income. So solutions like inflation-linked bonds, liquid, sustainable corporates, or emerging markets. All these ETFs allow investors to build truly diversified global portfolios. But we don't, as a passive provider, we don't take a specific bet. What we do is basically we try to provide the best solutions and the best tools for investors. This is our job ultimately. This is a question that an active manager should ask. So a manager who has a skill to kind of predict what are the trends in the market and where to allocate. Where we are putting a lot of emphasis as an ETF provider is development of the shelf in the sustainable. So we see a lot of growth in sustainable solutions, and this is where we put a lot of emphasis, both in equity space as well as in the fixed income space. And as I said, we also try to equip our investors with fixed income solutions. So only recently we've launched high quality liquid asset ETF, which is kind of an aggregate solution, investing in high-grade governments, in high-grade corporates, and allows investors to find, let's say, a safe haven asset type of investments. Well, passive investors, dependently on the asset class they invest to, are still exposed to the risk of the underlying instrument, right? So if the investor is invested into equity, the market risk, so to speak, is the biggest risk. If he's invested, let's say, in the fixed income corporate world, the credit risk is the biggest exposure that he has in the portfolio. So this is what it has to be understood, that in the passive space, investors hold the risk of the underlying instruments, either equity risk, commodity risk, or the credit risk. In the fixed income space, there is also other elements like duration risk or interest rate risks, etc. Well, every now and then, if something happens in the market, always this question comes up: is this a key moment? Is this about to change? But we've seen over the last few years that after some stress scenario, there's a quick rebound of different asset classes, right? Whether we're going to see in 2019 or 2020 a massive economic recessions, I don't know. It might happen that some asset classes will face some stress scenarios. In equity, everybody's talking that we might experience some drawdown, 20 or 30%, I don't know. But essentially, you have always certain asset classes where you can hide, your exposure, basically. Well, in the US, because you specifically brought the example of US market, which is very retail driven, there is indeed a proliferation of ETFs which are very tactical in nature. So they are introduced to the market and address a very specific thing happening in that market. For example, driven by regulation around the marijuana market, right? But these are the solutions which are not for the long-term investors. They are short-term, typically a short-term investment thesis. Now in Europe, the market is still driven more by institutions rather than retails, but these things are also changing. So of course we are thinking about introducing some ETFs which are addressing certain themes, but more focusing on the longer term themes. Like for example, sustainable development goals, gender diversity. This is a longer term theme for investors. It is a big trend, and the biggest risk of investing into thematic ETFs is the theme itself. How is it specified? Let me give you an example. Big data, for example, right? There is many ways to define a big data ETF. You could either focus on infrastructure, so the hardware, you could more focus on the software. So it really depends how the index is or the strategy is constructed. So there's a lot of risks embedded into that. And if the theme plays out, then of course it can generate a lot of returns for the investors. We are doing a lot of research on our end, also specifically looking into different thematics, and we have some projects undergoing, and hopefully there will be something going on soon. Well, generally speaking, environment for passive, including ETFs, is still very supportive. So we in Europe specifically observe still a continuation of shift from active to passive, of course. And there is a lot of drivers for that. Regulatory changes, increasing awareness of investors, proliferation of the products, etc. I mean, on our end, UBS ETFs, we have seen strong inflows, positive inflows across different solutions. And particularly in sustainable ETFs, we have a market leadership position. And investors are perceiving us as a leader in that space. And we have been expanding our shelf quite considerably. So we've launched gender diversity ETF, which has attracted more than 150 million in less than 1 year. Other solutions like developed equity plus emerging equity, ESG universal, social responsible ETFs, this all helps to investors to build sustainable portfolios. So we see a big trend in sustainable ETF for sure. Well, the market over the last 7 years, the ETF market over the last 7 years has grown roughly 20% on a compounded annual basis. And that has been mostly driven by, of course, a positive momentum across the markets, both equity and the fixed income. If in a scenario that we're going to face some economic recessions maybe or some tensions, that pace may slow down. On the other hand, we are still thinking that because of many drivers, we will still see a shift from active to passive at a certain rate.